There's a couple different ways to use them. A lot of traders use them to try and trade in between, buy when it hits the lower band, sell when it hits the higher band. That's one way to use them. Another way
Welcome back, traders and investors. We have a special guest on the line, and that's Randy Frederick. He's the Managing Director of Trading and Derivatives for Charles Schwab. Randy, how you doing this morning?
I'm great, Joel. It's great to be with you.
Yeah, thanks for coming on. So could you just give us a little detail on your role at Charles Schwab?
Yeah, I sure will. So what I do is I'm the head analyst for the people who trade options and also those people who trade a little more actively maybe than regular people, so people that are kind of engaged in what's going on in the market on a day-to-day basis.
Okay, is that for little retail guys like me and institutional investors, or do you focus on one or the other?
Well, Schwab is primarily a firm that focuses on retail investors, so that would be the bulk of the people that I'm speaking to. The ones that are probably going to be looking at the commentary I put out are primarily going to be retail investors.
Okay, and we spoke yesterday in preparation for the interview, and you made a really good statement, and you said, it's important for people to use options in the proper way, to trade. Could you expand on that?
Yeah, I sure will. When for years and years, when people traded options, everyone sort of thought that these were probably the people who were doing high speculation, taking big risks, putting a lot of money down on a, sort of a big gamble, waiting for a big payoff. And there are people that do that, and there'll probably always be people in the derivatives markets that are speculators. But the reality is that the primary reason derivatives, especially listed options, which is my area of expertise, were created specifically for purposes of hedging and generating income. And largely about half the business out there is that. The other half is speculation. But that's actually a good thing, because what makes the market work is that you have hedgers who are willing to spend a little bit of money to get rid of some risk, and then you have people out there who are speculators who are actually willing to spend a little money to buy risk. And so when you have people who want to buy risk and people who want to sell it, that's what creates the market. So it works really well. But, for retail investors, I've been in the business for 26 years, Joel, and I've never met too many speculators who are able to speculate on a regular basis and have long-term success. Those that largely do well over the long haul are generally people who figure out how to use options to hedge so that they can reduce the risk of their equity portfolios, and at the same time generate income so they can make money when the markets are going sideways. And what they're really doing is they're not trying to hit home runs, they're trying to hit singles, and they know that adds up over time.
Okay, and so just I know you do a Friday report and you give your outlook, talk about the market for the prior week, and then look forward to the upcoming week. We had a big sell-off here, and what kind of strategies do you, let's say, for a person that has like a fairly small portfolio, do you recommend, selling calls against some of their long positions? Do you recommend some downside puts, or what are your some preferred ways of hedging stock positions?
Well, covered calls are a great strategy, and they're still one of the most popular strategies out there, but it's not a great strategy specifically intended for hedging. It does give you a very modest amount of downside hedge, and in fact, given the recent pullback we just had, which was somewhere between about 7.5% and 9.5%, whether you mark, depending upon whether you mark it on a daily close or an intraday basis, a good chunk of that risk could have been put away just with the income from a covered call right. But generally, if you're trying to protect the downside of a position or of a portfolio against a big downturn, which we haven't had for a very long time, really since the fall of 2011, the better strategy to use is a protected put strategy, or my favorite was just really a collar strategy. A collar strategy is nice because what it does is it gives you the downside protection that you get from a protected put, but it doesn't cost nearly as much. In many cases, it can cost nothing. About the only thing you have to worry about when you do a collar is you just have to be willing to give up a little upside. But if you're nervous and you're afraid there's going to be a pullback, it's not the upside you're worried about, it's the downside.
Could you give us an example of a collar in a particular stock and a particular price? Like, let's say 103 up here in Apple, moving towards all-time highs. If you don't want to sell the stock, or you don't want to sell calls and have the stock taken away from you, and the puts. Well, how would you execute a collar on this trade?
Yeah, so let's take a look at it. And when I say this, keep in mind, I'm not giving any sort of personal opinion about Apple or whether I think it makes sense to do this or not. We're just using it as an example. Like an XYZ stock. So let's say you were nervous about Apple for whatever reason and you felt that there was a possibility that it was going to go down, but you're not sure, because if you're sure and you own it, you should get rid of it. There's no better strategy to get on a stock you own that you're afraid is going to go down than to just sell it. But you own it, you think it's good for the long term, but maybe you're a little nervous about, say, the upcoming earnings season or something like that. To do a collar, what you're actually doing is you're selling a covered call, and you're taking the income that you generate from the sale of that covered call, and you're using it to purchase downside protection in the form of puts. So what you typically have to do to execute a collar is you have to simply tell, like on our trading platform, Street Smart Edge, you just have to tell the platform how far apart you want the strike prices of the put and the call to be. So let's say, for example, if I was looking at Apple, it's around $100 a share, roughly. Let's just call it that to make the mathematics simple. I could look at, let's say I wanted to hedge out to the middle of November. So the normal expiration for November is the 22nd. I'm looking at Apple around 102 and change at right now, which gets up a little in the pre-market. But I could put on a collar where I sell a 104 call, so you're about $1.20 out of the money. And at the same time, I could buy a $94 put, and I can actually execute this trade for zero. So it's essentially at what we call even. So the only cost to this trade is just a couple bucks in commission. So the reason that works is because by selling the 104 call, I bring in about $1.40 in income, and then to purchase the $94 put, it costs me about $1.40. So one brings in money, one spends money, and the two net out, and you end up just paying a little bit in commission. The benefit here is that if Apple just gets clobbered and drops to 80, you've got the $94 put, and you can get rid of the position at 94. Or what most people do is, instead of getting rid of the position, if it's gone down, they'd actually like to hang on to it. They just sell the 94 put at a profit, and they use that profit to offset the downturn in the stock. But if Apple skyrockets and goes to 110, you're on the hook with an obligation to sell the stock at 104, which isn't bad because that's $1.20 above where it's at right now. So you just got to be willing to give up the really big upside to use a collar. But otherwise, I just think there's no better strategy to use when you're nervous, because the good thing is if neither of those things happen, then ultimately the collar just expires and it doesn't cost you anything to get in. It doesn't cost you anything when you lose it.
Right, little bit of commission there. So there's been some enhancements to the Charles Schwab options platform for 3- and 4-legged strategies, kind of like what you talked about. Can you talk about those latest enhancements?
Yeah, absolutely. I've been with Schwab for a very long time, about 21 years, and Schwab was trading 3- and 4-legged option strategies several years even before I started with the company. But up until just about a few months ago, our ability to do that electronically has been somewhat limited. We've always had multi-leg trading capabilities, but the more complex strategies such as 3- and 4-leggers, for many, many years, there really was very little retail interest in that. And part of the reason is because the commission costs were just so much higher than they are now. The cost to do a multi-leg option trade now has gone down about 80% from what it was at when I started with the company over 20 years ago. So when that happened, then all of a sudden these complex trades that involve lots of legs and lots of commissions became very affordable, and the retail interest has gone way up. So one of the things that we've done is, a few years ago, we acquired a specialty option firm that I'm sure everyone's familiar with called Options Express. It's now part of the Schwab family. And one of the reasons we did that was that they were very, very good at some of these more complex types of strategies. And we recently have not only taken what they had in terms of 3- and 4-leggers, but we've made it even better, and then we've added it to our flagship platform, which is the Street Smart Edge platform. So what's nice about this is that you can now execute virtually any combination of 3- or 4-legged stock and or option strategy that you can come up with. Now, many of them are pre-formatted, so standard butterflies like call butterflies and put butterflies, whether that's long or short. There's a formatted screen that gives you all the legs, and all you got to do is pick a couple items, and it automatically sets it up for you. Same thing is true for condors and also iron butterflies and iron condors. So all of the more common 3- and 4-legged type strategies, there's now a pre-formatted order entry screen that picks up all the information. Even neater, though, is once you enter the trade or once you get the legs picked out that you're interested in, it automatically calculates your break-even prices, your max gain, your max loss, and you can get not only the numbers, but a visual depiction of what that profit and loss chart looks like, not only at today, but also at the midpoint and then at the expiration date when the trade's supposed to pay off. the cool thing about that is you can adjust those, you can put your targets in. So let's say you expect the stock to get to a certain point maybe a week or two from now. You can put that in and you can get a visual of what that looks like as well. So we've made it really, really easy for people to do these 3- and 4-legged strategies. The commissions are very affordable now, and they get instantaneously executed just like anything else if they're marketable. So it's a real nice improvement and something that our active options traders are excited about.
Okay, let's talk about some of the other advantages of the Schwab platform. Of course, you get Randy's Friday report looking at the market, but there's also other things that people can use. If they want to start to get into a trade or a stock or whatever. What other things does the platform offer?
Well, there are a lot of nice features we've had in here for a very long time, and some of them you may find at other brokers, some of them you may not. I'll give you just a few good examples. When you look at a chain of options, you originally have the ability to look at all the different expiration dates, and then you can drill down into a specific expiration date and get the whole chain of all the different strikes that are available. Once you pick a particular strike that you're interested in, you can drill down another level into that strike and look at that specific option contract, and you'll find out literally everything you could possibly want to know. You can get you can get the open interest, you can get the previous close, the high and the low. You can get the notional underlying value. If it's an adjusted option, you can find out how many shares and if there's any cash in lieu it's available. It'll tell you whether it's an AM or PM settled, whether it's American or European style. You can get an individual quote from all of the 13 different options exchanges, assuming it's a big company that trades on all of them, and some of the big ones, like, say, Apple, for example, do. So you'll get a list of all of the exchanges. It'll automatically rank them by, highest bid, lowest ask. They're color bracketed so you can see when there's multiple exchanges at the same price. And then I think the time and sales window is probably one of the most useful pieces because it'll show you all the trades as they're executing, what price they're trading at, what time they went through, how many contracts, which exchange they traded on. They'll be color-coded to tell you whether they traded below the bid, at the bid, between the bid and the ask, at the ask, or outside of the ask. So you can kind of get a feel by watching this activity where trades are going off, how much flexibility you might have with regard to trying to enter an order at a limit price, say trying to buy just below the ask or sell just above the bid. If all the trades are clicking off at the bid and ask, you can probably know ahead of time that your limit order may not be taken. But if you see that they're trading a bunch of them between the spread, it gives you a better idea. And I think one of the most useful features about that window is the fact that anytime a multi-leg strategy goes off, there's a little thing we call a condition code that's also printed out on the time and sales to tell you whether that order was part of a spread, part of a straddle, part of a buy right, whether it was done manually or automatically through the computer, the automatic execution system. And the reason that's useful is because what a lot of retail investors don't realize is that if you enter an order and you improve the market and you become the best bid or the best ask, you automatically, most retail investors make the assumption that if a trade goes off at that price, that it should be them and they're next in line. What a lot of people don't realize is that if a different customer comes in after you and wants to enter a multi-leg trade that involves two different options, if one of those options can trade at the price that you're sitting at, they actually jump in line ahead of you. And that's just a standard rule that's been around on the exchanges for many years. But sometimes people are disgruntled when they see other people trading and they thought they were in the front of the line. What they didn't realize was that was because it was a multi-leg. So our platform will tell you that kind of stuff too, so you always know what's going on.
Okay, and Schwab also offers some fundamental information on stocks as well. If you're kind of new to the game and want to find out some fundamentals, what does Schwab have to offer?
Yeah, fundamentals are pretty. It's pretty extensive, to be honest with you. I mean, there's a group of guys, a real smart group of guys, about 15 or so of them up in Chicago that are. Many of them are very, very have advanced degrees in mathematics, and they've built this pretty extensive algorithm that generates what we call the Schwab equity ratings. And that is, we try to make it real simple. We rate every stock in the marketplace with either an A, B, C, D, or F rating. And what's neat about this, and this is one of the places where we differ a lot from what's going on in Wall Street, is that our equity rating system is positioned on a bell curve, a normal distribution curve, which means there's going to be more C's than anything. There are going to be fewer B's and D's and even fewer A's and F's. And the reason we do that is it's intentional. It's a forced ranking because many people who've been in the markets for a long time probably know, especially if you were around back in the days of the internet bubble, that in late stages of, say, 1999, something like 90% of all the stocks out in the marketplace were rated as a buy, and of course a lot of those got decimated in the spring of 2000. that doesn't make a lot of sense. So the way this works is a stock's only good if it's good relative to its peers. So this way, you've always got it set up in such that most stocks fall within the middle range, which makes a lot of sense. What's useful about that is whether you're an equities trader or an options trader, and I do a lot of live presentations. Just about every week I'm somewhere around the country doing presentations. Is I always tell people, because a question people ask a lot is, well, how do I take these 5,000 stocks and find some good ones to look at? And the answer is just go right to the Schwab equity ratings, look for the A's and B's, which are the ones that are expected to outperform their peers, and now you've got a much more manageable list that you can start with. And then if you're interested in a certain type of strategy, then you can do some options analytics on top of that. So lots and lots of fundamental data. But what's nice is that you don't have to understand how a balance sheet works. You don't have to know how to read an income statement. You don't have to understand price to book and price to earnings ratio and all that. What you can do is kind of be lazy, if you will, and just rely on the Schwab equity ratings, because they do all that hard work for you, and it's all been sort of dwindled down right into a single individual rating that takes into account all of the fundamentals. So it's very nice. And then if you're technical, like a lot of us are, you start out with a fundamentally sound stock, then you apply the technicals on top of that. And when you're trying to do an investment, the best stocks you're going to find are those that are fundamentally sound and technically strong. And when you cross the two together, you get yourself down to a very manageable list, and you'll find this what I would like to always call the best of the best.
And I guess you could also use the ratings in another way, too. If you have a lower rating on a stock and you're looking to purchase puts, that could be another way to make use of the Schwab rating system.
That's exactly right, and that's the whole point, is that if you want to do bearish strategy, then there are a variety of different bearish option strategies, and just exactly the same as I look at the A's and B's for a bullish strategy, I'll look at the D's and F's for a bearish strategy, and everything will work out about the same way. Just make sure that you're using bearish strategies.
Okay, and also just talking about the general market in your report that you do on Fridays. I mean, I'm kind of like an old school technician. I love to pay attention to the charts. To me, price doesn't lie. How much of a factor, how much emphasis do you put on technical analysis?
Well, the technical analysis that I use is a little bit different than the traditional technical analysis. And we spoke about this yesterday, Joel, that technical analysis from the perspective of directly applying technicals to an equity is a very well-established discipline. Chartered market technicians study a long time to become experts at all this stuff. But those of us that work in the options industry, it's a much newer industry. It's only been around since the early 1970s, which is way, way less time than the equity markets have been around. So the sort of the discipline of doing analysis in any way on the options and the derivatives markets is kind of still being written right now. And me and a number of others out there that do what I do are still sort of writing that. But I focus a lot on things like put-call ratios, like changes in volatility, and there are a lot of different put-call ratios. Whenever I hear someone say, well, what's the put-call ratio saying? I always say, which put-call ratio are you looking at? You've got equity ratios, you got volatility ratios, you got index ratios, and you got ratios that are based on open interest and ratios that are both based on volume. So at the very minimum, there's at least about 8 or 10 of them out there, and every one of them tells you something different, and they work in a different way. But all of those things, the whole point, and this is kind of the basis for all the research that I've been doing for many, many years, is that when big players in the market, like hedge funds, have an opinion about something, what they tend to do is they tend to go to the derivatives markets first, and they put their ideas to work there first. And that's a very important thing, because whether you're an equity investor or a futures investor or a stock investor or options investor, whatever you might be, what we're all looking for is an early warning about what's going to happen. And if we see the big participants out there taking action in the derivatives markets, even if I'm just trading a stock, it's nice to have, maybe a few hours or a few days or longer of early warning about which direction the market might be heading. So every Friday I put together a pretty extensive report, and it's published on both the Schwab trading community and the Schwab.com website. And it's an outlook just for the next week. So people who are engaged in the markets on a day-to-day basis, they just want a really short-term forecast, that's what they'll find. So I apply not only the derivatives markets, technicals, if you will, to provide an outlook, but I also look at traditional technicals. I mean, today's a good example. The S&P 500 closed yesterday right below the 200-day moving average, which was a pretty significant breakdown when we saw that about a week ago. And technicians are probably looking at this as, hey, maybe there's a pretty solid clear signal here that this slump we've just been in may be over. So those are all important things, and we talk about all those things each week.
Okay, great. And just to wrap things up here, just advice for, and I don't want to go for people that have been in the market, but let's say for, the younger generations, the millennials and stuff, a lot of their parents and family have had, some ups and downs in the market over the last, 10, 12 years. What words of advice would you give out there to, younger people, the millennials that are just getting started, in the investment world?
Well, that's a great question, and there are a lot of good answers. Let me give you some of the basic ones. The first one is that the earlier you start in your lifetime, the better. That's the biggest one. And I've got two kids who are both been out of college in just the last few years, and you can imagine how I've spoken to them. They're both starting their careers. They've got new 401k plans that they're investing in, and the most important point I've driven home to them is that you have to start early. That's by far the most important piece. The second piece is that even if you eventually get to a point in your career where you decide you want to be a little bit more active participant in the market, you want to trade a little more strategically, this is the most critical piece of all. Never ever be an active trader with your entire portfolio. No one who trades actively should ever actively trade their entire portfolio, because if you just have one misstep, one wrong turn, you can get clobbered and wiped out. If you want to be an active trader, and I've been an active trader myself for about 15 years, I've been an investor for way longer, what you need to do is carve out a small portion of your portfolio. And what I typically recommend is something less than 30%, maybe 20 to 30% at the most. For most people, 20% is probably a better choice. The remaining 80%, what we call your core holdings, should be in a very well diversified account that has many asset classes. You need to have small caps, mid caps, large caps. You need to have fixed income products. You should probably own foreign stocks. You should probably have different ETFs that specialize in different market segments. You should have all those things going on. And then that particular holding, you should review maybe about once every 6 to 12 months and make strategic changes based on areas of your portfolio that have outperformed. Maybe you take a few profits off and you buy some of the areas that have underperformed. And then what you do then is you have the ability to take advantage of this thing we call sector rotation. So all throughout the life cycle of the market, you've got early, mid, and late stages of a bull market, and you've got early, mid, and late stages of a bear market. And we go from bull market to bear market to bull market to bear market all the time. The bull market trends tend to last anywhere from 3 to 7 years most of the time. The bear market trends tend to last about 1 to 3 years most of the time. And you just adjust things based on what's going on. But different sectors of the market tend to perform well in different segments of different parts of the cycle. So that's when you make those adjustments. But the part you want to trade actively with, where you're paying attention to technicals and all these sorts of things, that can be a really fulfilling and very enjoyable activity. But you got to make sure that you're doing it with money that won't wipe out your retirement savings if you make a wrong turn.
And I think that advice can apply to new investors as well as people that have been in the market for quite a long time. We've had Randy Frederick on, and he's the managing director of trading and derivatives for Charles Schwab, giving us a peek into the features of the Charles Schwab platform as well as his views and strategies in the market. Randy, it's been a great interview. Thanks for coming on, and we certainly hope we can get you on once again.
You're quite welcome, Joel. It was my pleasure.